Welcome to Multifamily Investor. I'm your host, Andy Hagans. Joining me today is Jimmy Atkinson, one of the foremost industry thought leaders in the world of opportunity zones. Jimmy, welcome back to the show.
Wow, great intro, Andy. I love it. One of the foremost.
Yeah,
I think I finally made it.
I would call you the Opportunity Zones Sherpa, but I believe that title is already taken by
That
our
title's
mutual friend.
taken, and I think Wizard of OZ is also taken, unfortunately. So
Okay.
I'll accept one of the foremost. I think
Well,
that's
you
accurate.
are. I'm not just talking him up for our audience. Jimmy is one of the foremost people, notable people in the industry of opportunity zones. And he's also an expert on tax advantaged real estate investment. I should say passive real estate investments, right? Because this show is all about passive investments in multifamily. Multifamily, all forms of commercial real estate typically come with significant tax advantages. And that's really with any type of private equity real estate fund, right? For LPs in any type of fund, usually you're getting some tax advantages. But there are other ways, I often use the term stacking tax advantages, right? So like you can invest in a DST or in an opportunity zone fund or in some sort of tax advantage wrapper. And then within the wrapper, the asset itself will also have tax advantages. Basically, I can't get enough tax advantages. And I think most, most private investors, right? This doesn't really apply to institutional investors, but high net worth investors, ultra high net worth, family offices, they're very focused on their triple net returns, right? Their investment returns net of fees, net of inflation, and net of taxes, which is why the 1031 exchange is such a popular mechanism in the world of commercial real estate investing, and why DSTs have also gained in popularity. And we covered that product, the DST, in our previous episode. Now we're going to shift talking about opportunity zones and opportunity zone funds. Jimmy, opportunity zones are a lesser known vehicle overall. Is that right?
That is right. And I'll just start by saying I believe that opportunity zones are the greatest tax incentive ever created, Andy. And
Bold words.
I'm gonna try to back that up now
Okay,
with why.
back it up. Are they even better? Well, you know what? I was gonna ask, are they better than the 1031? But I don't even want, that's like which one of your children do you love more? It's like I don't want to even hear the answer to that. Tell us why opportunity zones are the greatest tax incentive ever created.
Well, Andy, how would you like unlimited tax-free growth? Something that's akin to essentially an unlimited super Roth IRA. Does that sound pretty nice?
Sounds too good to be true.
That's not too good to be true if you're an opportunity zone investor.
Okay.
Now, I'll say this. There are caveats with investing in opportunity zones, but essentially you do get access to a vehicle that allows for unlimited tax-free growth akin to a super Roth IRA. And what it is essentially is it's a capital gain tax benefit that as long as you hold your opportunity zone investment for at least 10 years, you never have to pay capital gains tax on the appreciation of that investment.
Okay. So that in and of itself, it's that's huge, right? And unlike an IRA, it's going to have there's no limit to the amount that you can invest in an opportunity zone fund, right? But not everyone is going to qualify to make an investment into an opportunity zone fund, right?
That's correct. And let me actually answer your first question, which was, hey, why is this one a little bit lesser known than 1031s? So 1031s have been around for over 100 years. You know, what eventually became known as Internal Revenue Code Section 1031, and then evolved into a DST type of structure about 20 years ago as well, was when the first DSTs started to become available. You know, that's been around a long time. Those types of investments where you can swap till you drop, essentially, as you like to say, Andy, defer capital gains tax out of one real estate investment property into a new real estate investment property, continued to defer until you die, and then the assets get stepped up to fair market value for the purpose of your heirs, and so they owe no tax on your real estate investment portfolio after you pass away. Now, opportunity zones are much newer. They came into law as part of the Tax Cuts and Jobs Act of 2017. The zones themselves were designated in 2018, and final regulations were only approved by the IRS toward the end of 2019. So they've really been around for, about 5 years or less, depending on who you ask. So there's a lot of attorneys and CPAs and real estate experts around the country who should be familiar with this, but aren't for whatever reason, or have some misconceptions about it, have heard bad things about it. There are some nationally recognized experts in this space who, do have accounting practices, legal practices. There are a lot of high net worth investors and family offices who are taking advantage of this, but I think the number of investors who stand to benefit from opportunity zones and should be taking advantage of opportunity zones is far smaller than it actually is. I think a lot of high net worth investors should be taking a closer look at this program and should at least be familiar with this program to know enough to be able to, say yes or no to it, to have an option of being an opportunity zone investor, Andy.
Because Jimmy, from one standpoint, there's a lot more high net worth investors who are going to qualify to make an opportunity zones investment compared to a 1031 exchange, right? Because you might be an investor in mutual funds, ETFs, stocks and bonds, or even you passively own some different private equity funds or different alternative investments, but you don't directly own any real estate. And so you may just not qualify to do a 1031 exchange, even though, you've heard about them, you understand them. But nevertheless, you probably could qualify to invest in an opportunity zones fund, right?
Correct. And by the way, you're kind of telling my story now, and I'll tell my story as well. And what I mean by that is, like, I'm not a real estate guy. Prior to a few years ago, I had no real estate investment experience, other than, having a primary residence, of course, but I wasn't investing passively or actively in real estate investment properties. I was I'm an entrepreneur. I've sold some businesses in the past. I have a stock portfolio, or I should say a mutual fund portfolio of stocks and bonds. I'd say pretty plain vanilla investor overall. But a few years ago, I learned about opportunity zones. I put together OpportunityDB, the Opportunity Zones database, and an accompanying podcast, the Opportunity Zones podcast. And, I had some capital gains events during that period of time. And I was, I realized one day, hey, wait a second, I should probably put my money where my mouth is. I'm going to become an opportunity zone investor, because the opportunity I saw, Andy, was, hey, the stock market's pretty highly appreciated right now. Maybe it's a little bit overvalued. I was looking at this in 2020 and 2021 mostly. Stock market, I had some fairly low cost basis gains in the stock market because I had been investing, for a decade plus, basically, since the Great Recession ended. Basically, is kind of coincidentally and luckily for me when I began my investing career. So I had some gains locked in, a lot of unrealized gains. And I decided at that point in time, hey, I've got some gains from these capital gains events that I triggered in 20 and 21. Let's roll over these gains into an opportunity zone fund or two. And by doing so, I was able to do two things. One, I was able to take advantage of all the tax benefits that opportunity zones have to offer. And then two, I was able to diversify my portfolio a little bit as well, because I was underinvested in real estate. I had no real estate investment property exposure. So get a little bit of real estate in my portfolio, divest from stocks a little bit, which I felt were a little bit overvalued, and get access to this huge best tax advantage ever created, as I like to call it, Andy. So I guess to answer your question about, I think you asked this question, who is eligible to invest? And I'll look at both programs that we're kind of considering right now, a 1031 exchange or an opportunity zone fund. With a 1031 exchange, you have to be a real estate investor in order to conduct a 1031 exchange or invest passively into a Delaware statutory trust or DST 1031. If you have a gain from anything else, like the sale of privately held business, the sale of your stock or mutual fund or ETF portfolio, maybe you sell some collectibles, comic books, art. Maybe you are a cryptocurrency investor and you sold some Bitcoin at a pretty low cost basis and high appreciation. Well, before it kind of went into the tanks here the last couple of years, but we had a lot of crypto investors in our network. in, I guess, 2019 and 2020, especially. Any of those types of gains can be invested into opportunity zones. Both real estate gains, gains from the sale of real estate, or gains from non-real estate transactions can be rolled over into opportunity zones. And so that's like the first caveat. In order to be an opportunity zone investor, you have to roll over a gain into a qualified opportunity zone fund, which then invests in properties that are located in opportunity zones. So now that's the second caveat. Okay, I mentioned this before, that the zones were designated in 2018. What did I mean by that? Well, this is a place-based policy. And in order to be an eligible opportunity zone investor or an eligible opportunity zone fund, you need to hold properties that are physically located in one or more of 8,700 plus census tracts around the country that have been deemed by the Treasury Department and IRS as opportunity zones. So they're typically low income communities, because the entire intent behind the policy is to lift some of these left behind, economically distressed communities out of poverty and to drive private capital into these locations where it's typically that have typically not been able to raise private capital. So I'll stop there, Andy, and see if you have any other questions.
No, I think that is the thesis. I think that actually is helpful. It's kind of the ideological or political or economic rationale behind the program. And so, you're going to be seeing heavy value add or opportunistic or ground up construction. So it's a different risk return profile than the typical assets that would be in a DST and a Delaware statutory trust. I want to rewind just a second, Jimmy. It was really awesome how you kind of shared your journey into real estate investing. And I want to zoom out and just talk about that in the context of this podcast, even. We're still in these first several episodes of Multifamily Investor of this podcast. I'm really excited about this show because it's like there are dozens, maybe 100 or more different podcasts about multifamily real estate out there being published. But Jimmy, you talked about your journey. To briefly talk about mine, it was in roughly that same time frame. I had sold a private business and I had a significant capital gain from that. That's when I first invested into multifamily, but I wasn't like flipping assets or doing value add actively. I invested as a limited partner, as an HNWI, accredited investor. And so we wanted to do this show, the Multifamily Investor Podcast. It's the first time in our company's history that we've launched a show exclusively covering this sector. We wanted to cover it from that perspective of the limited partner, right? Because there's so many, there's so much content being published by sponsors, by issuers, by syndicators, by asset managers. By the way, I love a lot of that content. But I think we need to hear from limited partners, from LPs. How did you get started? What's your mindset? Why did you invest in this? So Jimmy, that was really helpful to hear from you, how you are a limited partner in opportunity zone funds. It kind of mirrors my own journey as a limited partner in, by the way, opportunity zone funds, also different other private equity real estate funds. And on that note, I want to ask about the funds themselves. Because we talked about DSTs that will, last couple of years would open and close in a matter of weeks. Now they're open a little bit longer. How about qualified opportunity funds? How long do these funds stay open? How many of them are out there accepting new investors at any given time? Could you provide some examples? Well, why don't we just start with that first question? How many of them are there out there at any given time?
No, absolutely, Andy. There are dozens, if not hundreds of them out there at any given time. Kind of depends on what you mean when you ask, how many qualified opportunity funds are there. So I'll get to that answer in a minute, but I want to touch on one more thing that you mentioned briefly in your last response, Andy, which was the vast majority of these, actually all of these opportunity zone funds, are ground up construction or heavy value add, substantial improvement, as it's termed in the regulations. And the reason for that is because, well, it doesn't really matter the reason for it. There's a policy intent behind that. So you can't, when you become an opportunity zone investor, you cannot simply just buy and hold a stable cash flowing asset. you have to actually improve the neighborhood. That's the reason behind it. So the types of assets that are eligible to invest in are ground up construction, or you take a building and you substantially improve it, you double the basis in the building itself. So that's I guess the third caveat. If I mentioned a couple others before, that's the third big one that you should be aware of as an opportunity zone investor.
So there's a lot of regulations covering these. It's not like similar to the DST program. It's not an unlimited program that is the Swiss Army knife that could apply to anything and everything, right? It's
correct.
Specific. It has huge advantages, but then the caveat is it's specific to these types of projects, specific to this type of wrapper. But again, to qualify, any type of capital gain will qualify.
Yep.
As long as you're an accredited investor. I think a lot of these funds have minimum investments of $100,000, sometimes higher, sometimes 250,000 or 500,000, sometimes a little bit lower than 100,000, but it's sort of a typical private equity real estate fund. But there aren't thousands and thousands of these open like there would be with a lot of other, kind of like multifamily syndications. There are, I guess, how many of them would you estimate are open right now or have been open historically, accepting investors?
I'd say that there have been historically maybe hundreds of these that have ever been open. At any given time, there might be a little over 100, maybe somewhere between 100 and 200. Now, by the way, if you ask the IRS how many there are thousands of them. But
that don't get off the ground necessarily, that
either don't get off the ground funds, or that are what are referred to as captive QOF. So Andy, you as a high net worth investor could set up your own qualified opportunity fund, but that doesn't necessarily mean that you're raising capital from other investors. Maybe you're able to self-fund it yourself, or just you and a buddy are able to fund the whole thing. It's very simple to start your own qualified opportunity fund. But for the purposes of our podcast,
just sorry to clarify, I'm saying as an LP, I'm presuming we're all LPs here.
Correct.
We're family offices or HNWIs. We have, let's say, a $500,000 capital gain to place. What would be my options, right? How many options do I have? Where do I find them, et cetera?
Yeah, well, you find them on our website at OpportunityDB.com. Click the link up top that says funds. By the way, I'm out on our funds page right now, and we are currently listing 135 offerings that are open. There may be
and how many of those are multifamily, right? Is there a quick way to get that answer or to kind of estimate?
Yeah, you can select a real estate sector, and then we've got multifamily housing as one of the options. That drops it down to 64. So you got rid of only half of them. And I will say, yeah, the vast majority, well, I guess it's not the vast majority, but the biggest plurality of opportunity zone funds have some exposure to multifamily. And the way that these funds work are they can be sector focused, they can be geographic focused, they can be single property, they could be multi-asset. You can slice and dice these qualified opportunity zone funds kind of any way you like. And we feature a lot of the top opportunity zone fund sponsors, opportunity zone fund managers on our thrice annual event that we hold called OZ Pitch Day. Click the link at the top of OpportunityDB that says Pitch Day, and you can see all of the funds that we featured on our last program, which was just back in July of 2023 here. Some of the funds that we featured, I'll just give you a few of them from the top down. You stop me when you've heard enough, Andy. But the first one was Urban Catalyst. They are a real estate developer in San Jose. They're developing specifically in downtown San Jose, California. They're doing multifamily, office, hotel. I think it's a 4, and I think they have some senior living too. It's a 4 property portfolio. By the way, Eric Hayden, their founder, told me at OZ Pitch Day live, I hadn't heard this before, that they are very close to converting their office building back to multifamily because office has been hurting lately. So that was a little bit of news there, but can't say I was too surprised by that. So it's probably going to be just multifamily and a little bit of hotel as well. The next one that presented was Caliber. They are a large asset manager and developer in Phoenix, Arizona, and they're developing a multi-asset, very diversified portfolio of, it's probably going to be like maybe 25 to 35 different properties located all across the greater Southwest, as they term it. So pretty much anywhere between Texas and Utah is kind of where they're developing. That's their sweet spot. And then we also had a single asset fund by Your Space America Self-Storage. They're developing one specific asset. It's going to be a self-storage facility just down the street from Chase Field in downtown Phoenix. Chase Field's where the Arizona Diamondbacks play, in case you're not a baseball fan. I think you're a baseball fan, though, Andy. So that's three of them that were featured at our last event. They're all currently taking investors. And like you mentioned, Andy, there are minimum investments for these. The type of, I don't think you asked me specifically the type of investor who should consider an opportunity zone fund. But first of all, it has to be somebody with a capital gain. And then I would also say it has to be a sizable enough gain that, one, makes it worth your while to do the additional tax preparation you need to every year, and two, that meets the minimum investment thresholds of a lot of these funds, which oftentimes can be $100,000 or more.
And Jimmy, yes. So just to clarify for our listeners, probably the best way to browse the funds is through that website, OpportunityDb.com, Jimmy.
That's why I made it, right, Andy?
Yeah, that you work so hard to build. And a lot of these funds are doing ground up construction in multifamily. A lot of them are also multi-asset that includes some multifamily and some other types of assets.
But some are concentrated, some are single asset. If you just like the look of one particular deal, you've got options there as well.
We're running short on time, but briefly, I'm wondering if you can walk us through the timing, because I mean these are kind of unique. Number one, they're ground up construction, right? And they're a lot of times you're looking at hopefully a refi and year 3, 4, 5, something like that, so you get some cash back. And then they ultimately have a 10-year hold, which I know a lot of DSTs or other products will have like a 5-year hold or different hold periods, but a 10-year hold is a long time. So walk us through kind of all that timing from the perspective of an LP. Like, hey, today or yesterday, I just locked in, I just sold some mutual funds. I made $100,000 capital gain, which is great because I know $100,000 is the amount I need as a minimum investment for a lot of these OZ funds. But as an investor, then how does the timing work really for the lifetime of the investment?
Yeah, I'll walk you through it, Andy. By the way, unlike a 1031 exchange or a DST, you don't have to invest the entire sales proceeds of your transaction into a qualified opportunity fund in order to receive the full tax benefit. You merely have to invest the gain or part of the gain, by the way. You don't have to invest. You can kind of, so if you don't want to invest all 100,000, maybe you only want to invest 50,000, and then you've got another $50,000 worth of gain you can do something else with. And then you still have your principal, right? Your cost basis. I don't know what, let's assume that was what, let's say it was 50. Let's say you had a pretty big appreciation on this. Let's say it was a $50,000 cost basis.
2008. Yeah, I invested in 2008 in an
let's assume $50,000 cost basis. You sold it for $150,000, right? Normally with a 1031 exchange or DST, you'd have to invest the entire 150 to be eligible for the full tax benefit. Here, you can keep the $50,000 principal, so to speak, and then just put the $100,000 of gain to work. Okay, so now let me walk you through the timing. You have 180 days from the date that you trigger that gain to roll that gain over into one or more qualified opportunity funds. It's only $100,000, so you're probably just going to roll it into one fund because the minimums on a lot of these funds are $100,000. You can, by the way, there are some funds that'll let you invest $50,000 or maybe even less, but $100,000 probably you're just putting it into one fund. So you've got a long time, and you've got the next, some people say 6 months, by the way, but it's not quite 6 months. It's exactly 180 days. All right. And you want to make sure that you keep track of any receipts you might get or any statements you get from your brokerage that will indicate what the date is. So you have a paper trail just in case one of those 86,000 new IRS agents comes knocking on your door in a few years to verify that you adhered to all the timing requirements. You never know. So just within 180 days, write $100,000 check to one of these funds that I just mentioned. And then you get access to a few different tax benefits. The first tax benefit you get, Andy, is you get a deferral period. So that $100,000 gain would normally go on your 2023 tax return, and you'd owe, let's say you'd owe I guess it'd be $23,800 if it was taxed at the normal 23.8% capital gains tax rate. I've included the NIIT in there as well.
Or 57% marginal rate if you live in Connecticut, right?
Yeah, there you go. Or California or New York or one of those other places, right?
Sure.
Instead, you get to defer recognition of that gain until the tax year 2026. So that tax bill of $23,000 and change would normally come due April of 2024. You now have essentially a 3-year tax-free loan from Uncle Sam. It's not due until April of 2027. One thing to note is that the 2026 rate will apply. You don't get to freeze the rate in place. So that's a little bit of a risk there, tax rate risk. If tax rates go up, your tax bill might be higher than it was if you had just paid it in 24. But it could actually benefit you in the long run, because the higher capital gains tax rates go, the more valuable this program becomes, the more valuable the second benefit becomes. And that second benefit is, I mentioned at the top of the show, as long as you hold your opportunity zone investment for more than 10 years, once you transact, once you have a capital gain event from the sale of your opportunity zone investment, you escape capital gains taxation completely. What happens technically is the asset steps up to fair market value upon the date of the transaction. So you don't have a capital gain to report that year. And that's it.
And Jimmy, I got to say, to interject, to me, that's the most interesting thing, is because that's the major pro and the major con, right? Like that is kind of the drawback, but it's also totally awesome that if I hold this for 10 years, that capital gain comes out the back end tax-free.
Exactly.
Totally tax-free, but that means it's a 10-year hold. So it's really, you got to go into this as an LP knowing like this is totally illiquid, even more illiquid. Like some of these privately traded REITs, you might you have quarterly liquidity, or you might pay a penalty if you cash out, in less than a year or whatever. Or DST might have a 3 or 5 or 7-year hold, but this is a 10-year hold. I mean, this is really one of those longer holding periods, but that matches up exactly with the tax benefit, which is get that 10-year hold. That's where I get the truly massive tax benefit, which
Correct.
is the super Roth, as you, I believe, named it, right?
Correct. And I've got 2 comments on everything you just said there, Andy. One is, one other timing thing to consider is that these investments should be cash flowing at some point in time. But unlike a DST investment, that's typically you're investing into a stabilized property that's already cash flowing. With an opportunity zone investment, like I mentioned, it's much more opportunistic. There's ground up construction risk, or there's, a heavy value add and a lease up period. It can take 2 years, maybe 3 years before these assets start to cash flow. So they're going to be illiquid, and there's going to be no cash flow for a couple of years. By the way, these are generalities. Check with the fund manager before making an investment. Don't just go off of what I'm saying here. I'm speaking in terms of generalities right now. Sure. They have their own pro formas you should look into. The second comment that I'll make, Andy, is that the 10-year hold can turn off some investors. And I would just encourage you as an LP, anyone listening out there, anybody watching, yes, it's true. It's illiquid for 10 years or more sometimes. But the way I like to think about it is, think about it as a retirement fund. Think about it as a 401k or a Roth IRA, as I've alluded to earlier. Mm-hmm. If you have an IRA or a 401k or any other type of retirement fund, you're not like checking your watch and like, hoping, boy, I hope these years pass by quicker. When can I take the money out?
You're letting it ride.
You're letting
Let that baby ride.
So you shouldn't be thinking about, hey, how soon can I get cash out of this thing? Yeah. Because remember, this is basically unlimited tax-free growth. Instead, you should be thinking, hey, wait a second. How long can I let this thing eat? How long can I let this thing compound? Right. As an investor, you want to keep this compounding for as long a period of time as possible. So that's the mindset that I think a lot of investors have to take when they make an investment into this type of fund. It's not for everyone, right? But if you're an investor who has a capital gain, a sizable capital gain, if you're an accredited investor, if you can afford to be patient with this capital, it's definitely worth considering.
Absolutely. Jimmy, I can't thank you enough just for giving us this crash course into the world of opportunity zones for multifamily investors. I think there's a lot of great multifamily qualified opportunity funds out there. That being said, where can the listeners of this show go to learn more about opportunity zones with your podcast and website?
Well, first of all, we have a free guide. You can download the free guide at our website. Just head to OpportunityDB.com/download. If you want to listen to the podcast, got a different show every week where we feature a different guest and talk about different opportunity zone investing strategies.
A lot of multifamily in there too.
A lot of guests. I was going to say a lot of guests are multifamily because multifamily is the largest asset class for OZ investors. You can learn more about that podcast at OpportunityDB.com/podcast, or just search for Opportunity Zones podcast in your listening app, whether it's Apple, YouTube, or Spotify.
Awesome. Jimmy, this has been super, super helpful. Thanks again for joining the show today.
Thanks, Andy.